Investment Analysis of South Bow Corporation, SOBO. Pure Play Infrastructure Facing Deleveraging Imperatives. I. Executive Summary, Investment Thesis and Recommendation. South Bow Corporation, SOBO, presents a unique investment profile as a specialized, pure-play liquids energy infrastructure company operating the critical Keystone pipeline system. Spun off from TC Energy Corporation, TRP, in October 2024, the company's core investment appeal lies in its reliable, fee-based business model characterized by highly contracted cash flows and minimal required sustaining capital expenditures. The central pillar of the investment thesis is the stability offered by its asset base, with approximately 90% of the projected 2026 normalized EBITDA secured by committed contractual arrangements. This structural stability generates a highly sustainable quarterly dividend of US $0.50 per share, resulting in an attractive current yield of 7.8%. Critically, the projected 2026 distributable cash flow (DCF) of $655 million provides a strong coverage ratio of approximately 1.57x over the dividend. However, the investment is currently constrained by an aggressively leveraged balance sheet, a consequence of the spin-off. Key financial metrics, notably the interest coverage ratio of 1.92x, place the company below typical investment-grade standards, creating a material risk discount in the market valuation. Therefore, the company's disciplined capital allocation strategy prioritizes balance sheet repair over major organic growth, utilizing retained cash flow to strengthen its financial position. The market's valuation appears to be focusing more on the immediate credit risks than the long-term intrinsic value of the contracted cash flows, which some analyses suggest is substantially higher. The analyst consensus rating hovers near a hold position, with an average 12-month price target of $26.41. The hold recommendation is maintained until the company achieves tangible milestones in its stated deleveraging efforts. The substantial dividend yield compensates investors for the short-term credit risk, while execution of the debt reduction strategy is expected to catalyze multiple expansion. 12-month price target $29.50. I. Corporate Overview and Strategic Foundation. A. The strategic rationale of the spin-off. South Bow Corporation commenced operations as an independent, publicly traded entity following its spin-off from TC Energy, TRP, on October 1, 2024, via a plan of arrangement. This corporate restructuring was executed to unlock shareholder value by allowing two specialized, independent companies to emerge. The core rationale for the separation was to achieve operational specialization and enhance capital efficiency. By isolating the liquids pipelines business into SOBO, the new entity can concentrate purely on crude oil transportation, managing its capital structure and growth objectives independently. Simultaneously, the former parent company focuses exclusively on natural gas and energy solutions. The transaction was designed to be tax-free for both Canadian and U.S. shareholders, streamlining the transition for the legacy investor base. This pure-play liquids focus, while simplifying the investment thesis, also concentrates regulatory and geopolitical risks inherent to cross-border pipeline operations. B. Asset base and geographical advantage. South Bow owns and operates critical liquids pipelines and infrastructure extending across Canada and the U.S. The foundational asset is the Keystone pipeline system, which forms a strategic corridor connecting substantial Western Canadian crude oil supply to key refining and demand hubs in the U.S. Midwest and Gulf Coast. Management emphasizes that this infrastructure is characterized by irreplicable assets. This characterization points to the high regulatory hurdles, capital costs, and long development timelines that create a robust competitive moat, protecting SOBO's market position against new entrants. The pipeline's linkage to the high-demand U.S. Gulf Coast is particularly valuable for securing long-term contracts for the transportation of Canadian heavy crude. C. Business model and financial objectives. SOBO's business model is explicitly designed for resilience, focusing on maximizing utilization of its current asset base through fixed-fee and highly contracted arrangements. The primary financial objective is to attain and maintain an investment-grade debt capital structure. This objective is directly linked to the company's capital allocation priorities, underscoring the necessity of financial strength built upon stable, predictable cash flows. The highly contracted nature of the business ensures that 90% of the projected 2026 normalized EBITDA is insulated from short-term fluctuations in commodity prices and volume instability. D. Operational segments. South Bow reports results across 3 distinct segments. Keystone Pipeline System, the core transportation business. This segment delivered $260 million in normalized EBITDA in Q3 2025. Its performance is the principal driver of consolidated cash flow quality. Marketing. This segment, which utilizes spare capacity for commercial opportunities, introduces variability into the otherwise stable consolidated results. The segment reported a normalized EBITDA loss of $17 million in Q3 2025. Intra-Alberta and Other. This segment focuses on internal connections and smaller projects, contributing $11 million in normalized EBITDA in Q3 2025. The performance disparity between the high-quality Keystone segment and the volatile marketing segment is crucial for investors to monitor. The loss pulled the consolidated normalized EBITDA for Q3 2025 down to $254 million. This element of commercial risk contrasts with the low-risk profile of the core pipeline franchise. 3. Operational and commercial review. A. Throughput and capacity utilization. Operational results demonstrate consistent utilization of the Keystone system. In the third quarter of 2025, the average throughput on the Keystone pipeline reached 584,000 barrels per day, with the U.S. Gulf Coast segment reporting even higher volumes at 703 MBLD. The commercial environment, however, remains competitive. Projections indicate that Canadian crude production is likely to grow modestly in 2026, but overall production is expected to remain below available pipeline capacity in the region. This condition implies that SOBO cannot rely on maximizing volumes simply by meeting unconstrained demand. Instead, commercial success depends on strengthening customer relationships, offering enhanced optionality, and maintaining competitiveness to secure marginal barrels on top of the contracted base. B. Capital discipline and maintenance strategy. SOBO demonstrates exceptional capital discipline, maximizing cash flow for debt reduction and shareholder distribution. The company reported $52 million in capital expenditures during Q3 2025. Management guided that for 2026, total capital expenditures will be minimal, $10 million for growth, completing the Blackrod Connection project, and an estimated $25 million plus or minus $10 million for maintenance. This low capital profile is exceptionally cash flow efficient. Furthermore, the company notes that maintenance capital expenditures are generally recoverable through its tolling arrangements. This mechanism effectively minimizes the true cash burden on the company, as costs are passed through to customers under established regulatory frameworks, thereby increasing the quality and sustainability of the reported distributable cash flow. IV. Financial performance and balance sheet analysis. A. Review of Q3 2025 financial metrics. The Q3 2025 results provided the first detailed look at SOBO's performance as a standalone entity, highlighting its operational stability tempered by its initial leverage. The consolidated normalized EBITDA remained stable sequentially, rising 2% from Q2 2025 to $254 million, primarily due to higher contributions from maintenance capital expenditures on the Keystone system, offset by the expected loss in the marketing segment. The most notable movement was the significant sequential increase in distributable cash flow, DCF, rising by $69 million from Q2 2025 to $236 million. This increase was primarily driven by the timing of tax payments and the successful implementation of tax optimization efforts following changes in U.S. tax legislation. This non-operational boost in Q3 DCF emphasizes that the figure is not reflective of the annualized steady-state run rate, a fact corroborated by the lower, more conservative 2026 DCF guidance. B. Debt structure and deleveraging urgency. The highly leveraged capital structure inherited during the spin-off is the primary factor limiting the company's valuation multiple. The analysis of Sobo's latest metrics confirms a substantial debt load. Total debt stands at $5.72 billion, composed almost entirely of long-term debt, $5.74 billion. Key leverage ratios. The debt-to-equity ratio is 2.19x, and the total debt to capitalization is 68.65%. Crucially, the interest coverage ratio is 1.92x. This metric, which measures how easily a company can pay the interest on its outstanding debt, is tight and signals a highly constrained credit profile, falling well short of the coverage ratios typically required for an investment-grade rating, often considered 2.5x and above. The high financial charges, anticipated to be $315 million in 2026, are a direct consequence of this leverage. The high leverage is the fundamental reason the investment strategy must prioritize strengthening the balance sheet. Until the net debt to normalized EBITDA ratio, currently estimated to be aggressive relative to midstream benchmarks, is improved, the company will remain highly sensitive to unforeseen operational risks or adverse interest rate movements. C. Dividend sustainability and cash retention. The commitment to a sustainable dividend is robust, supported by strong cash flow coverage. The annual dividend payout of $2 per share, US 0.50 quarterly, is highly attractive. Based on the projected 2026 distributable cash flow guidance of $655 million and assuming an estimated dividend payout of approximately $416.6 million, the forward DCF coverage ratio is approximately 1.57x. This substantial coverage ratio provides a significant margin of safety for the dividend payout, affirming its sustainability. Furthermore, this coverage implies that Sobo retains substantial capital internally, approximately $238 million in discretionary cash flow in 2026 after covering the dividend. This retained capital is strategically essential, as it must be fully directed toward debt reduction to achieve the stated investment-grade target, demonstrating a highly disciplined use of capital to maximize long-term financial strength. V. 2026 Outlook and Growth Strategy. A. Detailed 2026 Guidance. Management's 2026 outlook indicates a stable year focused on operational execution and financial consolidation. B. Segment performance drivers in 2026. The overall $1.03 billion EBITDA forecast masks underlying dynamic shifts between the operating segments. Keystone Pipeline System. Normalized EBITDA is expected to decline by approximately $15 million. This modest decrease is anticipated due to scheduled maintenance capital expenditures and ongoing tight pricing differentials, which continue to exert downward pressure on the U.S. Gulf Coast segment. Marketing segment. Management forecasts a significant recovery, expecting normalized EBITDA to increase by approximately $25 million in 2026, offsetting the losses realized in 2025. Intra-Alberta and Other. This segment is projected to increase by approximately $10 million, benefiting from the full ramp-up of the Blackrod Connection Project cash flows in the latter half of 2026. The achievement of the $1.03 billion normalized EBITDA guidance is contingent upon the successful recovery of the marketing segment. This dependence introduces commercial risk, as marketing returns are inherently more volatile and market-exposed than the core contracted Keystone flows. C. Capital allocation and deleveraging focus. Sobo's capital allocation approach is highly disciplined, explicitly prioritizing financial strength. The company's priorities are layered. First, paying the sustainable base dividend. Second, strengthening the investment-grade financial position. And third, leveraging existing infrastructure to expand competitive customer connections. The exceptionally low commitment to growth capital expenditures, $10 million, confirms that immediate financial strength is valued above organic expansion. This strategy maximizes the discretionary cash flow available for debt reduction, accelerating the necessary balance sheet repair and positioning the company to pursue future strategic development only once its credit profile is solidified. V. Valuation and market positioning. A. Relative valuation metrics. Midstream pipeline companies are typically benchmarked using EV to EBITDA multiples, reflecting the contracted nature of their cash flows. LTM multiples. South Bow trades at an enterprise value of $10.72 billion. Its LTM EV to EBITDA is 11.23x. Forward multiples. Based on the 2026 normalized EBITDA guidance of $1.03 billion, the forward EV/EBITDA ratio is approximately 10.4x. This multiple suggests a moderate discount when compared to best-in-class midstream peers who possess lower leverage and established investment-grade ratings. Price to earnings. The LTM price to earnings (PE) ratio is 17.8x, improving to 14.6x on a forward basis. The high dividend yield of 7.8% is indicative of the market demanding a significant cash return premium to compensate for the elevated leverage and post-spin uncertainty. B. Valuation disparity and analyst consensus. The analyst community currently maintains a cautious stance. The average analyst rating is a hold 3.00, with a consensus 12-month target price of $26.41. Interestingly, theoretical valuation models such as discounted cash flow analyses indicate that the fair value of SOBO's stable, long-life cash flows could be substantially higher, potentially exceeding $60 per share. This wide disparity between the fundamental cash flow value and the current market price, approximately $27.42, reflects the market's application of a heavy risk discount. This discount is directly attributable to the high initial leverage profile and the constrained interest coverage ratio, 1.92x. Until the company successfully executes its deleveraging plan and visibly improves its credit metrics, this market inefficiency is likely to persist. 7. Key risks and sensitivity analysis. A. Financial execution risk. The primary risk for SOBO is the failure to rapidly reduce debt and improve financial flexibility. The current interest coverage ratio of 1.92x places the company under significant credit scrutiny. Interest rate sensitivity. High financial charges, projected at $315 million for 2026, mean the company is acutely sensitive to rising interest rates or refinancing risk. Any increase in the cost of debt would further reduce DCF and potentially jeopardize the ability to meet coverage requirements. Operational contingency. If the high percentage of contracted EBITDA is temporarily compromised by an unforeseen operational shutdown or regulatory constraint, the resulting pressure on the net debt/EBITDA ratio would be immediate and severe, potentially straining the balance sheet repair timeline. B. Commercial and segment risk. The reliance on a significant recovery in the marketing segment introduces an element of commercial volatility into the 2026 guidance. If commodity spreads or commercial strategies fail to deliver the anticipated $25 million recovery, the consolidated normalized EBITDA target of $1.03 billion would be missed. This commercial risk stands in contrast to the stability of the core Keystone fee-based revenue stream. C. Regulatory and political environment. As a key cross-border energy infrastructure provider, SOBO remains exposed to political and regulatory risk, particularly concerning U.S.-Canada relations and environmental policy. Although management has stated that large-scale geopolitical issues are beyond their immediate purview, the long-term viability and optionality of the Keystone system depend on a stable regulatory environment for Canadian crude exports. I. Conclusions. South Bow Corporation has successfully established itself as an independent, high-quality, pure-play infrastructure investment with irreplaceable assets and highly predictable cash flows. The company offers a compelling value proposition built around a stable 7.8% dividend yield, which is well supported by a 1.57 DCF coverage ratio based on 2026 forward guidance. The analysis confirms a substantial valuation gap exists, driven by the immediate necessity of balance sheet repair. The aggressive initial leverage, exemplified by the tight 1.92x interest coverage ratio, necessitates the company's capital discipline allocating approximately $238 million in annual retained DCF toward deleveraging. The future price performance of SOBO is highly dependent on the successful execution of this financial strategy. Investors should monitor quarterly progress on net debt reduction and the interest coverage ratio improvement. Once SOBO demonstrates material progress toward aligning its credit metrics with investment-grade peers, the market is expected to re-rate the stock, allowing the valuation multiple to expand and the share price to converge closer to its intrinsic cash flow value. SOBO gives income investors an attractive yield, but investors should monitor the definitive progress for SOBO in achieving the stated financial objective of an investment-grade credit profile.